So we talked about raising $500 million. That was one investor at a time, and so the average check that our investors wrote was about $110,000, and so that was probably 1,500 investor conversations over the course of 2 years. And the reason that those people wrote those checks and invested with us is two very simple things, but they're often overlooked in kind of all the business world.
Welcome back to Curiosity Class, the podcast where we break down complex topics into easy to understand ideas and bite-sized pieces. My name is Jeff Album, and I've been a curious person my entire life. Inspired by Albert Einstein's quote, "If you can't explain something simply, you don't understand it well enough," we aim to make learning accessible and engaging. On this show, we're going to bring you experts from various fields, ranging from personal finance to physics, to help you understand everything from 401ks to how airplanes fly. So let's dive in and satisfy our curiosity together. What's going on, everybody? Welcome back to another episode of Curiosity Class. I am super excited to have my good friend Andrew Davis joining us today. Andrew is the founder of a company called Equity Check and a partner at a company called Fully Funded. And today we're going to be diving into all things commercial real estate. So Andrew, thank you so much for joining.
Thank you so much for having me. It's good to be with you again.
Back at you. I know we were just saying it's been a minute since we originally connected in 2021 in North Carolina, and that's where you live now, if I'm correct.
That's also correct.
Perfect. So catch me up with what's been going on. Like, give the listeners, who are you? What have you done? Where do you come from? What's your background?
Yeah, absolutely. So I'm Andrew Davis. You already said where I work. I live in Asheville, North Carolina, with my wife and two-year-old twin boys. And I grew up in the Northwest, always had like a real fascination with business. My uncle was a stockbroker, and both my parents were entrepreneurs. And so very early on, I was fascinated by business. I would wait for the Oregonian to come every day so I could look at stock prices. And it took me a long time. To discover real estate investing. And I always say if I had known about it earlier, I would have started earlier, but my parents were business owners, but I had never really been exposed to it. And so I got into sales, I did well in that. And I, by chance, picked up a Robert Kiyosaki book when I was on vacation in Hawaii. And funnily enough, it was a book that Robert Kiyosaki and Donald Trump, quote, co-authored, although I imagine they both had ghostwriters, and it was called "Why We Want You to Be Rich" or something like that. And when I look back at it now, I'm like, that was at best an average book, but I didn't have anything to compare it to at the time. And really what it did for me was open me up to the world of investing, of assets and liabilities, and the whole rich dad, poor dad kind of way of thinking. And what really sparked my enthusiasm was the idea of leverage and all the creative ways that you can utilize real estate, all the different ways that you can create income streams from it, etc. And so I just, like I do with anything when I'm interested in it, I just dove deep, read everything that I could, talked to everybody that I could, started investing in real estate a few years later. And kind of all the exposure that I had at that time it's what I call like the bigger pockets philosophy, which is go buy a bunch of single family duplexes, rent, 1 to 4 units, kind of small stuff. And that's the way to do it. And that is a way to do it. But I found it to be a very inefficient and annoying way to do it, just because I think there was a chunk of time where single family real estate was a great way to grow wealth and cash flow. Now I think it can still be a great way to grow wealth, but not so much cash flow. There's a lot of things that we can talk about that have changed that market dramatically. But long story short, I wasn't good at flipping houses. I really wasn't a good property manager. And I got up to about 16 units, and I was exhausted, and I didn't like it, and the idea of acquiring any more properties sounded terrible to me, and was fortunate enough to connect with a lot of people in the commercial space who were doing much, much bigger deals with a lot less headaches. And what I discovered in that time period of building this smaller portfolio was that while I was bad at flipping houses and managing properties and all that, I was really good at raising capital. and building trust with investors. And even though the projects didn't always go to pro forma, I always made sure the investors got their capital back. And so I realized, like, hey, I'm really good here, not so good here. So if I can join a PE firm, private equity firm, where I can just focus on building relationships with investors and raising capital, then that's going to be a pretty good role for me. And so about 5 years ago, I got my first job at a private equity firm and stepped into an entry-level investor relations role. And I was right. I was good at it. Over the course of a couple of years, I raised $500 million for multifamily, like apartments, for self-storage, for what a lot of people would call private credit now, which was just like a fix and flip fund, lending to flippers, and a couple of other different assets. And I was there for about 2.5 years, learned a ton, amazing experience. I went to go work for another firm for about 9 months, and then started my firm, Equity Check, about 1.5 years ago now. So there's my very long-winded introduction.
Dude, that's okay. So you said so many things that we could probably have individual episodes on with each bullet point, but a couple clarifying questions to start. Did you say $500 million with a B?
I did, yeah.
That is not a small chunk of change. So how like, for scale sake, like you said, okay, you had 16 doors on single family homes. Had you raised money for all those prior? Like,
yes.
Okay.
Yeah, just obviously on a much smaller scale. So I
Sure.
think the largest project I raised for was about $400,000. The smallest one was $90,000.
Okay.
And and so they were just literally individual investor relationships. In many cases, it was guys lending out of their like self-directed retirement accounts.
Okay. And
so
these were
it was
folks you were meeting just in your day to day, like you knew them,
Yeah, it was actually almost all on Bigger Pockets. So
Really?
Bigger Pockets, for folks that don't know in your audience, it's evolved into a real estate investing media brand. I think would probably be the best way to describe it now. When I first got onto Bigger Pockets, it was basically real estate investing forums.
Yeah.
Is what it was. They had just started a podcast, but it was nothing like what it is now. And I just got really active in there, asking a lot of questions, responding to people, and when I had a deal that I was raising capital for, I would just I'd design a little, a pro forma offering memorandum, whatever you want to call it, and post it on there, and would have people reach out to me, and I built, probably a dozen really good investor relationships from that site over time.
Wow. And this was all concurrently, like while you were working at W2? Were you still in sales
Correct.
at this point?
Yeah, I was still in sales. So this was a side hustle.
Okay. And so at what point did you decide, I know you said 5 years ago, but so you were probably pretty deep into your sales career at this point. Like that must have been a pretty big transition. Yeah?
Yes. I mean, yes and no. I am not cut out for the W-2 corporate life. And so, I think it was long overdue for me to really make that transition. And there was what shall I say here? There was a very fortuitous catalyst that made that transition very easy. I had spent several years in an organization, and I was, to put it mildly, mistreated on around the time that I made the transition.
Okay.
And so it was very easy for me to go, yeah, I'm ready to I'm ready to do something new. I'm willing to take a risk here. So it was, and I also was not in love with my sales career. I was good at it, but the only thing I enjoyed was the connections I made. I didn't really care about the company. I didn't care about the product. I mean, I shouldn't say I didn't care about the company, but it wasn't anything I was passionate about. So
Sure.
Yeah, it wasn't as hard as one might think.
And did you go from did you have a pretty good, I guess, how do I want to say this? Had you replaced more or less your income of your W-2 by the time you left, or was it a leap of faith, so to speak, where you were going into a place where you were going to have less stable income?
Yeah, great question. And so, there's a couple things that happened kind of concurrently that were just very, very fortunate. One of the things that I've always been a big believer in, and has been a goal for my wife and I, is financial freedom, which is just for us, it just means your investment income exceeds your expenses. And so I very much look at that, and I always encourage people to look at that as a process or a continuum. And so for us, the first step of that, or a key step of that, was having a home that pays for itself, or what some people would call a house hack. And so that happened right around the time that we moved to Asheville from Orlando, and we bought a home, which I'm sitting in now, with a 1,100 square foot Airbnb in the basement.
Okay.
And so that basically eliminated a $3,000 plus monthly expense for us by the time you did mortgage and utilities and all your expenses, et cetera. And then my wife is a very talented author, and her career started to take off around that time as well. And so, yeah, those two things happening concurrently definitely made that leap a lot easier.
Sure. Okay.
Yeah.
And so how long in between sales and then starting at the PE company? Like what's that timeline?
2 weeks.
Oh, wow. Okay.
Maybe 3 weeks. It was very fast.
Got it. Yeah. Okay. And and then what's the total timeline for your rental portfolio at this point? So you had gotten up 16 units over how many years?
Call it 6 years.
Okay.
Yeah, I call it 6 years, and in between there was buying and selling.
Sure.
There were a lot of flips on the front end, and then there was a fair amount of buying and selling in between there. And then when I first got into it, I didn't start out going, I want to get 100 units. It was like, I'm going to flip. It was just kind of like a squirrel. I'm going to flip houses. I'm going to wholesale. I just wanted to try kind of everything and see what resonated. And I realized that wholesaling and flipping houses were just another job and weren't reliable wealth generators. And so over time I went, okay, now I really want to focus on an income generating portfolio that's, quote, passive. Although I would argue that the passive that by the traditional definition, it is not.
Yeah. Biggest lie ever sold. Passive income.
Indeed.
Okay, so now you're at the PE company, you're learning a ton, and then you said there was another firm involved, and then you left to start what became Equity Check. So walk me through that. Like, what was that process like? Like, how did you go from, okay, I'm learning a lot, I'm liking what I'm seeing, but you had an itch to do something yourself? Like, what was the thought process?
Yeah, I mean, I think so. The entrepreneurial, I really enjoyed the first firm that I was at because it was startup. I think I was employee number 5 or 6.
Oh, wow.
And so give me a big challenge, give me autonomy, and put me in a seat where I'm doing something that I'm good at and I enjoy it, and I'm gonna kind of run until I pass out. And that's basically what happened. I mean, I just took on more and more and more responsibility over the course of my time there, from an individual contributor to running the entire IR department, the back office, marketing strategy, acquisition. Like, I kind of did not everything, but I had my hand in everything. And I really enjoyed that because I'm a sponge and I was learning a ton. But I got burnt out, as you do when you work 80 hours a week and are flying, on flights I took 100 flights my second year there. So I was just, it was just too much. And moderation is not my strong suit. And so around the time that I found out that we were having twins, it was like, okay, this work pace is not sustainable with me being a healthy, well-adjusted husband and father.
Totally.
And so fortunately I was able to take like 9 months off and just kind of get ready, rest, prepare our home, and get to spend the first 3 months at home with my kids, just all the time, which is great. And I think at that time, I probably, were it not for being a brand new dad to two young boys, I probably would have started the firm. But I kind of felt like I want to settle into this dad thing before I take another flyer on something brand new. And then after about 9 months, I worked for a firm called DLP Capital, and it's a great firm. I have nothing but wonderful things to say about them. I just was ready to jump out and start my own thing, and that's when Equity Check began.
Dude, that's amazing. All right, so give listeners an understanding of what Equity Check is, what made you want to start it, and then I want to talk to you about like what that process was like with going from a more traditional W-2 role into a full-on entrepreneurial venture yourself.
Yeah, absolutely. So, in short, Equity Check is a vehicle or a platform that connects investors with the highest quality alternative investments out there. And all I mean by alternative investments is that everything that's not the stock market, everything you can't go on Robinhood or Vanguard or whatever and invest in. So alternatives encompasses kind of everything in what they would call the private markets. So that anybody going for a drive wherever they are in the world, they're going to see something that's owned by a private firm. It could be an apartment complex. It's the retail, it's the retail shopping center you go to every day. That's owned by a private firm. It's the Starbucks you buy your coffee at. That's probably a triple net lease that's owned by somebody else. So it's everything that's not the stock market. That's not the public markets. And, in short, the inspiration for Equity Check was in my time in this world. I talked to, so we talked about raising $500 million. That was one investor at a time. And so the average check that our investors wrote was about $110,000. And so that was, probably 1,500 investor conversations over the course of 2 years. And the reason that those people wrote those checks and invested with us is two very simple things, but they're often overlooked in kind of all the business world. It's trust and confidence. And so it's integrity, and then it's competence. And so it's, hey, I trust that you're going to be a moral actor. I trust that you're going to act in my best interests. And then I have confidence that you know what you're doing, because somebody can be trustworthy and be an idiot. And somebody can be really, really smart, but not be trustworthy. And so if you're going to give your hard-earned money to somebody, you need both of those things in combination. And unfortunately, in the world of investing, and especially in the world of private investing, because there's not as much oversight, right? If you're a publicly traded company, you've got to do earnings calls. You have to submit very specific reports to the SEC. You have all these kind of accountability mechanisms, right? Where there's entire news channels dedicated to exactly what's happening with these companies at any given time. Whereas the private or the alternative world is kind of a black box. There's no enforced reporting requirements. You don't have to jump through a bunch of hurdles to get people to invest with you. And so what happens often, or I should say too often, is that unsavory characters can get into that space. They might be good marketers, they might be good salespeople, but they're not either high integrity or high competence. And unfortunately, a lot of people can lose significant money there, whatever that means to them. And so I was just really troubled by that. I was troubled by seeing, having conversations with investors who had lost meaningful amounts of money to them because they, placed their trust in somebody, and it wasn't honored. That company or that person was not a good steward of their capital. And so the core mission of Equity Check is to only bring my investors opportunities to invest with companies and with people that are both very, very high integrity and very, very high competence. And when you do that, it dramatically increases the likelihood that they're going to have a great experience and get a good return on their capital, and obviously decreases the downside.
Sure. Okay. And so does Equity Check act as, like, you have the relationships with investors? And so for those of you that may not know, usually they're called limited partners, right? LPs,
correct,
which means a passive investor. So you have the relationship with LPs. Do you also have the relationship with the firms who you were represent? Like, who does Equity Check represent in these?
Yeah, so primarily Equity Check represents investors. I mean,
okay.
The core of what we're doing is always acting in the best interest of the investors. And then, anytime, just because I guess of my experience and kind of connections in the space, I have a lot of firms or sponsors that come to me and say, hey, we're raising money for this deal. And then I view my role as to be the person that tears those opportunities apart and looks for every single possible thing that could be wrong with them, that could be wrong with the market, the business plan, the asset class, the operator, and have a very systematic process for how I go about that. But I very, very much represent the investors, and our tagline is literally investors first. It's very, very simple, but that's what that's how I function and work, and then investing alongside. And so really the key thing that I look for always is incentive alignment, right? And so I don't ever want to have a different incentive structure, an incentive structure that's outside of like my investors being successful. And so that's our core premise, is that we're all swimming in the same direction, and that if investors win, then sponsors win, then I win, and not in the reverse order.
Okay. And so just a couple specific questions on that. So like, let's say I have a deal, and I go to you and say, hey, Andrew, I have this deal I want to raise money for. I'm looking for $1 million raise. You're going to vet my deal and tear it apart and ask me a bunch of questions and, basically be like, well, what about this? What about this? Test my assumptions. And then you then turn around and pitch it to your investors. Like how does that process work?
Yeah, that's exactly right. Yeah. So if somebody brings me something, then I'm going to, I dismiss 95% of what comes across my desk very, very quickly.
Wow. Okay.
Yeah. So, so I dismiss the majority of it right away for a couple very just core principled reasons. And then, I'll go through. And so to give you context, I've been doing this for well over a year now. I represent 4 sponsors. That's it.
Whoa.
Or I have agreed to raise capital for 4 sponsors.
Wow. Okay.
So that's how selective I am. And honestly, I mean, that's selfish, because I don't ever want to have a conversation with an investor. Like, I want to sleep well at night, and I don't ever want to get a call from an investor saying, you pitched this deal to me and I lost money.
Right.
I just couldn't do it. I need people to like me too much.
Totally.
And so anyway, so that's effectively how it works, is I'll tear it apart, and then I will, and part of that process too is I have a few people in my investor base that I would put in the more sophisticated investor category. And so before I even go wide with it, I'll bring it to them and I'll say, hey, this is all the diligence that I've done. What am I missing? I want you to tear it apart. Would you invest in this? And then once I have that buy-in from kind of that advisory, sophisticated investor group, then I'll go out wider to my network.
Okay. Man, that's amazing. And so sorry if this is a frank question, but how does Equity Check get paid? Like, who pays Equity? How do you make money?
So the sponsors pay us directly. So it's never one of the the core things. Like, I couldn't have a mission statement that said investor first and then dilute my investors' interests, right?
Right.
Like that just seems a bit, what would you call it? Hypocritical. And so it's always the sponsor that's going to pay me, and the payment or the compensation structure that I strongly prefer is that I participate, and we can I guess kind of move into some terms and things, but I have a share of what's called the GP, or the general partnership. And any good private investment, the operator or the sponsor, the person that is running that business, that investment, they shouldn't get a big payday until after they've successfully executed on that business plan, whatever it is, whether they're aggregating flower shops, and that's a real pitch that I got in the last month, is some guy is doing a roll up of flower shops, which is actually very lucrative, but that's completely, that's a total aside. Or they're just doing a traditional, hey, we're going to buy this old rundown apartment complex and fix it up and then sell it in 5 years. But what I want to do is make sure that I'm not getting meaningfully compensated until my investors are. So the thing I typically negotiate for is that I am going to get a share of what's called the carry or the promote. And basically all that is that's enough. That's kind of the icing on the cake after the investors have gotten their invested capital back, or their principal, after they've gotten a preferred return, which is typically like a 7 to 9 to 10%, depending on the deal, on a return on their money. And then they are splitting the profits with the general partner or the person that's running, executing on that business plan. It's kind of the last money that gets paid out. And so that's where I strongly prefer my compensation to be. I have one sponsor that is so high quality that they've said no. They want to pay me on the front end, but what I do with that capital is I take the majority of it and I invest alongside the LPs that are investing with me. And so even though they're paying me on the front end, I'm just putting that right back into the project, and so my incentives are still aligned with theirs.
Gotcha. And so if it's all right, can we put some easy numbers to this to maybe help break it down a little bit more? So
you bet.
Let's use $1 million, and let's say you have 10 investors, each with $100,000 checks, right? So $1 million raise. So you're saying, you said a couple really interesting terms there. There's carry, there's promote, there's preferred return. So let's break down like what that would look like in this fake deal.
Sure. All right. So $1 million investment. So typically what you're going to see in any private, kind of standard private investment is you're going to see of course, a business plan, right? Which is like, here's the plan. We're going to buy this thing. We're going to do this to it. And it's like, here's what we're going to buy. Here's what we're going to do. Here's how you're going to get your money back. Here's how we're going to generate a profit for you. Business. When somebody makes an investment, we talked about the term LP, they become a limited partner. That's literal. They are a partner. They have an equity stake in that business or in that investment. So they are very much participating, but the limited is, it's kind of a double-edged sword. It's excellent in that there's significant liability protections for that person. So, if somebody sues or anything that could, cause them to be subject to a significant amount of financial liability, they're immune from. And they're also very limited in their decision-making power. So to use your example, somebody writing $100,000 check, they're not going to have any say in the day-to-day operations of the property. They're really not going to have any say at all. They can call, they can make suggestions, but at the end of the day, they're saying, hey, I trust you to run this project and do it as you see fit. So typically what you're going to see in an offering or investment opportunity is all those factors. And then you're going to see the returns, which is what everybody wants to see. So there's really two components of the returns. Well, three components, I guess, if you kind of divvy them up. So the first one is the preferred return. And there's a lot of nuances around this, but in short, the preferred return is basically the minimum return that the investor is going to get before the sponsor, the operator. These are all really interchangeable terms. It's whoever's running the business. Okay. So whoever's taking the money and doing something with it. That preferred return is the minimum return the investor is going to get before the sponsor takes a dime. Okay. So typically that return is going to be set depending on a number of factors, anywhere from 6% to 10, 12, 15%. And so that's the first, what you would call hurdle, that the project has to achieve before the sponsor or the operator can make any money. So let's just say in this case, it's $1 million investment. It's an 8% preferred return and it's a 5-year project. So those investors would have to make let's just take an individual investor, $100,000 investor, 8% preferred return over 5 years, set compounding aside for simplicity. They need to make $40,000 return over that 5-year period before the sponsor takes any money at all.
Got it. Okay.
Then after that, which you would call a hurdle, then you get into what's called the promote or the carry. And that very simply is just means how we're divvying up the profits after the investor has gotten their money back, plus their preferred return, plus their 8% or whatever the number is. And so this is where it gets very creative, or it can get very creative. And I strongly prefer that people err on the side of simplicity. And a lot of times what you will see is these very convoluted and complex, what are called waterfall structures, where it's like, okay, after 8%, the limited partner gets 80% and the sponsor gets 20% until a 13% return. And then it goes to 60-40 until we get an 18% return. Then it goes to, and it's basically, and the premise behind it is the better the deal performs, the more the sponsor should be rewarded. But that's effectively what it is. And those are the two key terms that you want to look out for when you're evaluating return potential for a deal is what's the preferred return? And then what is the promote or the carry? What's the split between the investor and the sponsor?
Got it. And I know on $1 million, maybe this isn't the best example, but just to continue with it, like how does the sponsor, because the sponsor has carrying costs and costs associated with running due diligence of the deals. So I understand there are some fees associated outside of the preferred return, right? So of that $1 million, like what to use an acceptable fee structure to keep the lights on of the sponsor? And same thing for Equity Check. Like what does Equity Check look for in terms of percentage of fees? Like how does that all work?
Yeah. Excellent question. So that, as they say, is the rub. That's the entire thing there, because it doesn't matter what the preferred return is. It doesn't matter what the promote is. Really what you want to look for at the end of the day is alignment of incentives.
Right.
And if somebody has a bunch of, so there's, call it, I mean, you can get as creative as you want with fees, but typically what you're going to see in a private, syndicated sponsored investment, you'll see an acquisition fee, you'll see an asset management fee, and you'll see a disposition fee.
Okay.
Oftentimes you will see a marketing fee as well, like a deal marketing fee. And then you see, if it's a development deal, you see construction management. People will throw all sorts of fees in there.
Yeah.
But really it's not so much about a percentage as it is where's the incentive for the sponsor? And when you have a bunch of fees on the front end, so to give you an example, I first started out exclusively in multifamily. That's all I was raising money for is multifamily, is apartments. And apartments are highly in demand from the investor side, because they're viewed as stable income. And so, investing in areas like Dallas or Florida or the Carolinas, you can pay, if you go buy, a luxury or a higher end apartment complex in your area and say it's a 200 to 300 unit building, somebody could have paid, 80, 90, $100 million for that building. And so if you have a 3, or I've seen even as high as a 5% acquisition fee, on the day you buy that, on the day the sponsor buys that or closes on that investment that they used other people's money to buy, they're walking away with a $3 to $5 million check.
But is that on the purchase price or that's on the amount raised? Because those might be different.
That's on the purchase price. That's acquisition fee is almost always on the purchase price.
Holy smokes.
So obviously the incentive is to buy. And if they perform on the back end, great, that's another payday for them. But if every single time you buy an asset, you have a 7-figure payday, then it's just human nature that you're going to focus on buying more assets. And I saw this over and over again. I saw groups before they ever returned their investor principal or made a distribution, they had multi-million-dollar paydays. And I kid you not, Bentleys and private jets. That's what was happening. And if you've not been in this world, that's like, oh my gosh, I can't believe this happens. It happens all the time.
But so even if they're getting debt, so like even if let's say the $100 million purchase price, let's say they raise 50 and they get 50 of debt, so they're still taking 5% of 100, which is actually 10% of the raised capital.
Correct. And not only is that a perverse incentive structure, but it also dilutes the investment, because that $5 million has to come from somewhere.
Right.
And so that those fees are all built in to the equity, to the capitalization of the project.
Holy smokes.
And this is something that people do not understand about how to evaluate a deal. Typically investors, especially newer investors, they'll look at oh, this seems like a strong market and these targeted returns make sense. And oh, okay, I get it. But what they don't look for is kind of where are the incentives?
Yeah.
And what I've found is, surprise, surprise, if the incentives are on the front end, if you get a big payday when you acquire or you get assets under management, that's the next fee, is the asset management fee. So a lot of times you'll see somewhere between I know people that don't charge any asset management fee, and then you'll see up to 5% asset management fees. That can be either on assets, which is the value of all your real estate, or it can be equity, which is the dollars invested. But to continue this example, on a $100 million apartment complex with a 3% asset management fee, that can be another $3 million a year. Or if it's just on the equity, it can be another $1.5 million a year. So again, the incentive is to buy to get assets under management, to just generate a ton of fees, not necessarily to perform.
Right.
So it's not so much about the percentage, although you always want to see a percentage on the lower end, but it's when does the sponsor win? And if the sponsor is becoming a multimillionaire the day they buy a property, buy an asset, before they ever deliver a dollar back to their investors, I don't care how competent they are, I don't care how great their deck is, that's a hard pass from me.
Totally.
Yeah.
So I guess what I still want to unpack a little bit is it almost seems, because even if you take a 1% fee off the $1 million, right, that still significantly impacts your returns, almost more so because the dollar amount is less than the $100 million one, right? So is that fair to say?
I'm not sure I understand your question. It's going to impact, any fee is going to impact your returns, but it's not like a 1% is a pretty reasonable fee. And the reason being is that in order to buy a $100 million apartment complex, especially in a competitive market, typically you're going to have to put down what's called hard earnest money. Mm-hmm. And so that's going to be, with a transaction of that size, that's going to be, you're competing with institutions and the BlackRocks of the world who can stroke a $2 million, earnest money check all day long. So there is significant risk for the sponsors on the front end, and there's significant diligence costs as well. And so I think a 1% acquisition fee, is super reasonable. And on a $1 million, deal, by the time you factor in earnest money and all the diligence that goes into it, I don't think it's unreasonable for somebody to walk away with mid six figures, and a lot of that's going to go into, or should go into, operations.
Right.
So I don't know if that answers your question or not, but it's not as if there's no risk or costs associated, but it's just what's enough to keep the lights on, and to meaningfully compensate them for their work, without creating such a perverse incentive structure that it's putting investor capital at undue risk.
Right. Okay. That makes sense. Mm-hmm. That makes sense. Man, I feel like I could ask you questions for days about this, but I do want to get to Fully Funded. So how did Fully Funded come about? What is it? How did you get started? Walk us through it.
Yeah, absolutely. So Fully Funded is a collaboration. I shouldn't say collaboration. So Sam Silverman is the founder of Fully Funded. I came on as a partner relatively recently. Sam and I have known each other for years. He's a very, very accomplished capital raiser, a very, very sharp operator. And really the genesis of what Fully Funded is today is wanting to create better outcomes for our investors. And so, like we talked about, when you're investing, $50,000 or $100,000 in a deal, in an opportunity, you're gonna get what you get. You're going to get whatever the preferred return is. You're going to get whatever the promote is, whatever the fee structure is. Say that group is raising $10 million to buy something. You as a $50,000 investor, or even a $500,000 investor, you're going to have very little bargaining power. And so what we've done, or what we're doing at Fully Funded, is we're bringing together what are called capital allocators. I would be considered a capital allocator or a fund manager. I have a group of investors. I bring opportunities to them. But again, even if I'm bringing a couple $1 million to a deal, my negotiating power is very, very limited. Whereas if I'm bringing $10 million to a deal or $20 million to a deal, then I can go to that sponsor and I can say, hey, we're making up, all of the equity in this deal, or we're making up 50% of the equity in this deal. We want a better preferred return. We want a higher share of the profits of the promote. We don't want to pay you a 1% acquisition fee on our capital. We're only paying you a 0.25% acquisition fee. And we want you to create a preferred share class for us, which de-risks the investment. So we have all sorts of negotiating leverage when we write a larger check. And then we can go back to our investors and say, hey, look, these are the typical terms. This is what we've negotiated. The returns are higher. So the upside is higher. The risk is less. And so at the end of the day, it's about creating a vehicle that accomplishes better outcomes for our investors.
That's super cool. And also, it sounds like the sponsors can go to one entity to get all of their equity in one shot, as opposed to $1 million here, $1 million there, et cetera.
It's a huge value add for sponsors, and exactly what you said, certainty of capital. Mm-hmm. And capital markets, just like any business, capital markets is just people investing money. Like any business, it goes through waves and cycles. And when I first started raising money professionally, when I raised that $500 million, it was a very easy time to raise money. There was a lot of skepticism about the stock market. The Fed was just printing money left and right, and a lot of people became wealthy during that time period through asset appreciation, through business growth, whatever it was. Now we're in a time where, for a number of reasons, it's harder to raise capital, and so for sponsors and operators, having certainty of capital and having a capital partner that knows what it's like to be on their side of the table and is not going to make life difficult for them, but understands like they need certainty, they need efficiency. It's a huge value add to them. It's a huge value add to the investors, and for us as well. Like we get to participate in the success of these projects, and so it's a value add for us. So we're always looking for the win-win-win. The investors win, the sponsors win, and then we win.
Man, that's so cool. And so for both Equity Check and Fully Funded, what are you looking for right now? Like, is there anything, if a listener's out there being like, I wonder how I can get involved, or what they're looking for, how I can help? Like, what are you looking for? Deals? Are you looking for sponsors? Are you looking for investors? Like, what are you looking for?
Yeah, thank you. So we'll start with sponsors because we were just talking about them. We want to look at, we've created an ingestion engine where we can look at a lot of deals. And so if there's a sponsor that's interested in, working with us at Fully Funded and wants to bring a deal to our network, they can just go to fullyfunded.capital. It's a very easy sponsor, quote application where they can just submit a little bit of information and we'll get back to them on next steps if it's a fit. For individual investors that are investing less than $1 million a year, Equity Check. I'm always looking to work with great investors that are looking for those cream of the crop deals that we talked about. And then if you're a professional capital allocator, if you're investing or managing over $1 million a year, then that's a great place to come join us at Fully Funded on the investor side to get those better terms that we create and generate for our investors.
Okay. Mm-hmm. Very cool. Well, man, this has been so cool. But I would be remiss if I didn't ask you one last question on a little bit more of the personal side.
Yeah.
You do a lot. You're a very high output individual. You mentioned that you have twin boys. So you're a father, you're a husband, you're an entrepreneur, you're a business owner of multiple businesses. You do a lot. Walk me through a Wednesday. Like, what's a typical day in the life? Like, what does it look like? What time are you waking up? What time do you go to bed? Like, what are you doing during the day? Like, walk me through it just very quickly.
Yeah, it's a great question. I don't I feel like there's so many ridiculous morning routines out there. I am very, what would I say? I am extraordinarily efficient with my time.
Okay.
And so I am always doing the 80-20 analysis. And so I'm very, very good at, some might say too good at like delegating or deferring things that don't matter. And that, I'm not saying they don't matter. It's just in my estimation, they don't matter. My wife would say that I have a very, very selective memory. So she'll be like, I told you that. And I'm like, I just didn't think that it was relevant anymore. And so I chose to forget it. Sherlock Holmes talks about it. What does he say? He has his like mind palace. I'm like, my mind palace is super efficient. But no, I mean, I really think what I really like about this business is it's so simple to me, and it's really about trust-based relationships. And when you have those, then then capital flows when you build those, and then you continue to earn those. And so I try to get lots of sleep. I try to rest well. I try to be really present with my kids. I honestly only work about 6 hours a day. If you consider sitting in front of the computer, but I'm thinking all the time.
Sure.
And so I've also like optimized for, I'll go for a walk, and I have like voice recordings, so I'm constantly dropping ideas in there. So I'm thinking about it all the time, but I don't really work that hard.
Yeah.
Yeah.
Well,
Yeah.
you're the epitome of the writings behind you. You're the man in the arena, which is it's pretty cool to see. So Andrew, thank you so much for coming on. I really appreciate you and your time and your wisdom. And yeah, I can't wait to do a part 2 where I can ask you all my thousands of more questions.
Anytime. Thank you so much for having me. It's a pleasure.
Awesome. Thank you so much, Andrew. Bye, everybody.